Now, if we're looking for something that's similar to PME, we might split revenue growth into addressable market growth and market share growth as we did in VC 113, and we might split multiple expansion into market multiple expansion and intrinsic multiple expansion as we did in VC 112. Technically, we could do the same thing with EBITDA margin expansion, but it's harder to find meaningful long-term data on EBITDA margins, so I think it's easier to just give the GP full credit or full blame for whatever happens with this value driver. At this point, we can rearrange the value creation components. We can add up addressable market growth, market multiple expansion, and sector gearing and call that the market-driven return. This is very close to what you would get if you invested in a basket of public securities in the sector. And then we could add up everything that's left and call that the manager-driven return, and that would be a proxy for the private equity GP's financial and operational value add. Now, on this chart, the manager-driven return includes excess gearing, but perhaps you don't want to give them credit for that since additional leverage comes with additional risk. Well, that's no problem. We could just pull out excess gearing like this, leaving us 3 value creation components, 1 market-driven value driver, 1 for the company being more levered than the typical sector peers, and the manager-driven return, which now includes market share growth, EBITDA margin expansion, intrinsic multiple expansion, and cash flow generation. The main point is that we can group these value drivers in any way that we wish, and then using the math we described in video VC 106, convert them into the other units of value creation.